Welcome to the PlanStrongerTV market update for Wednesday, January 7th, our first of the year. Welcome to 2026. We'll dive right in, Robert. So a lot to talk about, a year in review. Let's throw some numbers up there on the screen for everybody. I asked Robert to prepare 3 years for us to talk about, just to give you a little bit of perspective. So we're going to put the indices that we follow up on the screen, and then we'll go ahead and give you the 2023, then add the 2024, and then of course the 2025. These are total returns for each of the indices for each year. Now, that's a lot of data on the screen, but what you can see just looking at all of it together is that we've had 3 strong years, 3 broad strong years across all of the indices. Not every indice in the world went up, but the ones that we follow and the ones that are generally looked at for how the economy and the markets are doing, they've done well. So looking at that, Robert, what's the first thing that kind of jumps off the screen to you?
One of the 2 things that jumps off the screen, number one is the importance of diversification. You look at non-US stocks, among the lowest of the stocks, not including the bonds, of 2023, the very lowest of 2024, and then surging in 2025. I remember I had a fellow advisor with somewhere else say, international, I don't do international. You know, international is just so, they don't ever perform well. Well, you know, emerging markets and international, extremely good performance in 2025. And, again, the benefits of diversification. Second thing is bonds, just up 7.3% in terms of when prices go up, yields or interest rates go down, and that's kind of something I want to talk about 2025.
Okay, all right. So as you look at that, you say, "Wow, boy, things are great." And here's the predictable caution, maybe that people will expect. We've had times like this before, Robert, where we've had very strong years, and there are many periods of time we could go back and look at and say, look at the markets and how well they did. And the caution is that it's easy to get used to really good returns. It's easy to say, well, this is just the way it is. And things do really well. I'm just going to, keep investing. And so we want to remind everyone just to always keep in mind that the market doesn't always go up. And I'll give you some quick numbers that I pulled. This is a very interesting and significant, personally for me, period of time. I started Holland Financial in 1997. And so this period of time is very, very much something I remember. In 1997, and I'll look at the S&P 500. The S&P 500 was up a total of 33%, okay? So not unlike some of the recent numbers we saw. 1998, it was up almost 29%, and then in 1999, another 21%. So 3 very strong years. Well, you know probably where I'm headed. 2000, 2001, 2002 were 3 bad years. We had a negative 9%, 12%, and 22% for the 3 years that followed. So my point is that we see these very strong returns, but we can see periods where the market drops not only some, but very significantly. So, and one more point, and then we'll go to some of the other things that Robert wants to talk about. I just want to prepare people for what may come. A decline of 5% in the market historically, it can happen about once every year. So it's not really that unusual. So if you think about the Dow Jones Industrial Average that a lot of people follow, being at 50,000 points, a 5% drop, which would not be unusual at all, would be 2,500 points. The media will have a field day with that. And then a 10% or more drop is maybe every couple of years, and then a 20% drop happens every 5, 6, 7 years. So these things are not uncommon, Robert. They do occur, and I think it's a good caution for people to be thinking about that and where their portfolios are, and if they're in the right things based on their individual situation.
Yeah, and the only thing I would add to that is nobody, or if you can time the market in one instance, great, congratulations. But to do that consistently, you can't time the market. So it's like, okay, well, we have 3 great years. I'm going to put everything in cash, and then in 3 years, no, it doesn't work that way. So again, just kind of the timing indicator as well.
All right, so let's go to some details and some things that are happening, below the headlines and below just the stock market returns.
Yeah, well, I kind of want to talk about that. In 2025, one of the things that I looked at, which was kind of a major thing in retrospect, was tied to inflation. Just like in 2021 and 2022, the Fed missed the inflation is only transitory. When we had the Liberation Day tariffs beginning of April, mostly it was the media that really, and also our central bank, inflation is going to skyrocket. Inflation expectations did increase significantly. And on the show, we frequently say how expectations can kind of become reality, but we also have to look at the flip coin sometimes that, I haven't mentioned, but, looking back at 2025, I'm forced to, that reality also can come into play and say, and shape expectations, because those inflation expectations skyrocketed for May and June of last year, but they've come down significantly. Investors are finally starting to realize that, the hype around inflation because of the tariffs just have simply not materialized. So that's kind of one of the major lessons to kind of look back and learn and really, I know this is kind of a cliche, but you really do want to learn that lesson going forward, because yes, listen to different media sources, but really take them with a grain of salt. Take a step back. What does this mean? Do I really need to get all worked up and nervous about this? And usually if you have a plan, and David talks about it incessantly, as do I, stick with that plan, because it's so important not to get caught up in the hype of different media narratives that they spin.
And with that, Robert, if you are close to retirement or you're close to needing the money, that's a different story. And it's a funny thing to say, but I'm gonna say it anyway. If you are thinking about, well, gosh, I wonder if I should be in the market, I'm gonna need my money in 2 years. Guess what? You should already be out. I mean, I'm just going to say it. It's very unusual for us to see it make sense for somebody who is near to needing to draw and use a lot of their money that's invested in the market for it to stay there. It's just you are creating a situation where that if the market does fall, like we talked about statistically a moment ago, a 5, 10, 20% drop, you're creating a situation where you could get hurt at the very moment where you need the money. Yeah. So that's good. So with some of that, Robert, then where are we looking then at with these robust returns for the last 3 years? What are we looking at so far in terms of the data? Again, because that's what we're really getting at is the underlying data. What does it portend? What do we see as kind of how things may play out this year? Not a prediction, but just kind of what your thoughts are at this point.
Well, two thoughts come to mind. Number one is every other year in the United States, we have something called elections, and so the hyper partisanship that's out there. Well, I talked about I can't even use that word dialogue, the hyperventilation over the tariffs and inflation expectations. You're going to hear a lot more with a lot of other things, this year with elections. Midterm elections,
Yeah.
correct. So, that's kind of one area. But the other area is kind of, we always hear about the AI trade. And it is a paradigm shift, without a doubt. We have paradigm shifts occurring with AI, robotics, nuclear energy, not only fission, but fusion, quantum computing. So we have one article I read, and just within the last few weeks, and it was so much, it just screamed common sense, but it's worth me repeating to everybody. These paradigm shifts will not all take place or haven't taken place in the last 1 or 2 years. And then they will continue to evolve and grow and change over the coming years. But along with that will be volatility. So as we've been kind of hammering home, we'll have our ups, we'll have our downs. It's not all going to happen at once. Different companies will emerge. Competitors will knock out this company that is the golden child of today. So if you have 5, 10 years still, stay invested and stay diversified.
Well put. And we will want to always keep in mind the diversification component that Robert's talking about. You know, there are a lot of companies we can use an example, and we're not going to get into individual stocks or securities, but there are many examples of companies that are kind of the golden child, but they face competition from other companies that, you know, weren't a competitor not that long ago. So we're also cautioning about trying to go with Robert references the AI trade, meaning people really being excited about that area of the market. Yeah, it's definitely a paradigm shift, as Robert said, but that doesn't mean that we should go putting all of our money after any one thing. That's really a key thing to keep in mind, because we've seen and history has shown that sometimes people get it right, sometimes people don't. And it's just not appropriate for most people to try to make large bets on any one thing with the money that they're going to need for the primary funding of their retirement. Maybe for a small portion. Now, for the people that have other resources or more substantial resources, and they want to make a larger bet with some of their money, they can afford to do that because they know and they have to understand that it may not work. So a lot to talk about. We've gone a little over what we like to do in terms of the time, but we'll be back with more and continue to expand on these subjects to help you plan stronger in 2026.